White House making a big push this week to lower gasoline prices with a national gas tax holiday proposal and asking oil companies to ramp up supply. But my next guest says supply will be outstripped no matter what, and any government interventions could increase demand, make things worse. Joining me now is Stan Major. He's portfolio manager of the Hotchkiss & Wiley Midcap Value portfolio. Stan, welcome. And I'm especially glad that you're on today because sentiment in energy has gotten really bad over the past literally like 10 days. So why should investors not jump ship here if they haven't already?
Sure. It's great to be here, Kelly. When you think about the energy situation, there really is no long-term solution that's been proposed. So I thought it was interesting the other day. Mike Wirth, the CEO of Chevron, wrote a letter to the Biden administration. I'm sure it was heavily lawyered. A lot of people looked at it. One of the things that was striking in that letter was in the first paragraph. He said there aren't any short-term solutions, and I agree with that. There really aren't any short-term solutions to the situation we're in. The market is very tight. We're either slightly undersupplied or slightly oversupplied, but the real issue is longer term. Everything that's been proposed, whether it's an export ban, windfall profit tax, drop in gasoline taxes, some of those will make the situation worse. But really, there's been nothing proposed for the long run, and that's what's concerning.
The bears will say, okay, we had a 40-point rally in energy, and now we have signs of a correction in inflation and, you know, to some extent, kind of like a healthy normalization of the environment, maybe recession. Why couldn't we have an oil price in the 90s, say, instead of upwards of the 100s from here? Where do you think the price clears for the supply and demand that you're seeing?
Sure. So when we think about what the fair price of oil is in a balanced market, we use $65, $70 a barrel. So well below where we are. The issue is how do we actually get there? Historically, when you look at commodity markets, the way a commodity cycle ends is generally too much supply. So producers become overly optimistic. If you look at the last time oil was $100 a barrel, producers, management teams were very optimistic that growth in China, emerging markets, there was an insatiable demand for oil. So any project they could put on was going to work in the long run. So they were doing oil sands projects, deep water, exploring in the Arctic, et cetera, anything to bring oil on. Today, it's the opposite. No one has any confidence in the long run. That's really difficult for the energy business. It's a depleting business. These companies are on a treadmill. If they don't spend, production declines. And when we look around the world, deep water or offshore is about 30%. There's not a lot of exploration going on.
Sure.
Russia's in the news. That's about 11%. There's probably going to be a smaller market for their crude, so they're probably not spending a lot of money. In the U.S., there's growth, there's some drilling, but it's just too small.
What about refining? That's what Dan Yergin really put a spotlight on yesterday, and we all know it's contributing to higher gasoline prices. Would I, as an investor, want to own the refiners here if there, sounds like there's not going to be any significant expansion in supplies for some time?
Yeah, I mean, the refining market is tight, and it's why? It's because refineries closed down because the expectation was there wouldn't be enough demand. The difficulty with a refinery is it takes a long period of time to build a refinery. You have to expect that demand 10, 20, 30 years from now will be there. So there's just not a lot of short-term investment that you could put in there. Eventually, we think the refining market does get sorted out, but that will take a long time.
How long? And are the names that you like still names that you and I have discussed in the past in this space, like Cosmos and Berry and Ranger Oil?
Sure. We favor the exploration and production stocks. The investment thesis is pretty straightforward. If oil prices were to crash down to what we think of as a fair price, 65 to 70, you're getting some of the most undervalued stocks in the market. So they would have 10% free cash flow yields. If the situation persists and we have a very tight market, which we think lasts for a long time, these companies are generating 25 to 30% of their market caps in free cash flow. What are they doing with that? They're buying back stock. There just isn't enough stock for them to buy back. After a few years, they would have bought back theoretically every share that's outstanding.